Hello everyone. Welcome to a new video in which I'll be having conversation with Sagar, which is going to be very enriching for our audience and as well as myself. Let me start by thanking Sagar for doing this podcast and a short introduction about him. Sagar is founder of Rupeeting, an investment advisory firm, and also runs a PMS called as Patterson PMS. He has spent more than 12 years in the equity market across investment advisory, institutional broking, and asset management. So that's a short introduction. I'll leave it to Sagar to introduce more about himself and also talk about repeating.
Yes, thank you. Thank you for having me here. So I think you've covered quite a bit of it as a summary. But in short, I think I've been very passionate about stocks since the last many years, and have found that ikigai moment, which is what are you good at, what makes you money, and what makes you happy. So I think that confluence is important, and I've found that in what I do. Although what I've been doing is very different now. Running a business versus running a fund is miles apart, and a pretty good learning experience. So since the last 3.5 years, I've been running this company called Rupeeting. We're primarily an investment advisory. We have small cases listed on the platform. We've got about 7 to 8 small cases. Additionally, we also provide custom portfolio advisory solutions, both for stocks as well as mutual fund portfolios. And That's a fairly new product. But other than that, I also run a PMS which is a portfolio management service company called Patterson PMS. So that is a fairly new initiative, started only 7 months ago. But we've already reached about 100 crores in AUM in that. So pretty happy about the progress we've made in a very short span of time. Um, and yeah, looking forward to building more portfolios and managing portfolios for a larger set of people over time. That's the only objective now.
Fantastic, fantastic. I think 100 crores, it's not a small number. So you must be already doing some great work with that kind of clientele. I'm not talking about the money, but I'm sure the clientele is what makes a difference, right? So I think in the podcast, what we'll do is let's start from the beginning because most of my audience would be looking to understand about small case. They are actually looking at investing in small cases, all of those. So like to hear from you, like what is the difference between a mutual fund and small case and also direct stock investing. So how do you define this and how do you or what are the things which an investor should be looking at when they're choosing any of these products?
So I think mutual funds and small cases, very large differences, right? Although they are in essence portfolios that are built and managed by experts, mutual funds are very hands off. You give them money, they manage, they do the reinvesting. When you want to withdraw, you put in a request and you get the money back. Small cases become a little more complicated in terms of execution. They're effectively the same thing, but they are an advice to the client, right? So the execution is in the hands of the client. There's no trader sitting and executing for you. So you have to go on to the app after you get a notification, accept the rebalance, maybe add funds if required, maybe whatever. And then 3 clicks, but still, it is a process that is in the hands of the investor. So if somebody wants a complete hands-off approach, mutual funds work better. But I think the way I look at it is that small cases are a good start point for anybody who wants to invest directly into equities. So rather than choosing stocks by themselves, because investing is a full-time job, you can't just along with your main job be interested. You can be interested, but I don't think you'll be able to achieve good results in terms of analyzing companies in depth, understanding businesses, and then tracking portfolio of 15, 20 different companies together and managing it well. It's sometimes best left to a professional, and that's where small case steps in. So I usually look at small case as a bridge between mutual fund investing and direct equity. Everybody starts with mutual funds, but at some point in time, they want to move to direct equity investing as well. A good stepping stone is a small case, wherein you can get a professional to do it for you. and you also get constant notifications and advice, and hence you are constantly updated about what's happening in the portfolio. In a mutual fund, you're completely unaware of what is happening. You've given the money, you don't know the composition of the portfolio, nothing. In equity, there is full control. Small case acts like a blend of the two, which is a very beautifully placed product. So anybody who wants to start direct investing, I recommend that first you buy a small case, understand the process, understand when fund managers are entering, exiting, how they're rebalancing, how they're building a portfolio, and then you can do it yourself at some point in time.
Yeah.
So that's how I look at it from a broader angle. So, additionally, I think there is one more benefit that small cases offer compared to mutual funds. Mutual funds come from a very highly regulated space, right? So SEBI has a very high oversight. They have a lot of boundaries and constraints for mutual fund managers. So if a particular scheme is listed as a large cap scheme, it has to have about 65% of its assets in large caps. Similar for mid, similar for small, similar for focus funds. Percentages vary between 65, 80 or whatever, but to be true to character, there are a lot of constraints. Additionally, there are constraints in terms of how much exposure you can take to a certain sector, how much to a certain company. So all these things, I believe, land mutual funds in a position where they have to operate in a very limited space. So that at some point in time, according to me, compromises on the ability of a fund manager to generate returns. So, in order to be more conservative or in order to follow a certain set of rules, you end up in a place where there's too much diversification, for example. On average, mutual fund portfolios will have about 60, 80, even 100 plus stocks at a lot of times.
Yep.
However, in small cases, the advantage is that at least at repeating, what we try to do is limit the number of stocks to between 15 and 20. Mathematically, if you look at this, beyond 17 stocks, every stock that you add, the amount of risk reduction is far lesser than the amount of return dilution you're doing.
Okay.
So it doesn't make sense beyond 17 to keep adding stocks. You're actually making your portfolio inefficient.
Mm.
So from that perspective, I feel that small cases offer the advantage of much more concentrated portfolios compared to mutual funds. Of course,
Okay.
this is not meant for everybody's appetite, right?
Yeah.
This becomes more high risk, even visually, perceptively, as well as realistically.
Correct.
So people with a slightly higher appetite for risk could hence opt for small cases because they'd offer you much more potential for return. I'm not saying actually delivered, but at least the potential for return is higher in small cases compared to mutual funds, hence.
Also, my view is that it can be either mutual fund or small case, but I mean, you already have a mutual fund portfolio. If you're looking at direct, which you mentioned, look at adding small case, understand how it works, and then start building on the small case. I think that's also a strategy which should work fine, so that you understand all the risk return on small cases which you can generate. So yeah, I think yeah, fantastic. Explanation of what small case is, how is different from mutual fund. Let's dig deep
We
into
also,
what,
sorry, there
yeah.
is also a lot of, since we started this custom portfolio product, right? The way we approach it is that we do a portfolio review for people.
Okay.
In this, we realize that people who have been directly investing
Uh-huh.
are also collecting a bunch of 80, 100, 120 stocks.
That's something which can be totally avoided if you're looking at this as an option, right? So,
Exactly. So that's where a small case again fits in, because the moment they
correct.
look at how a small case is managed, they're like, hey, we are doing something wrong here.
Correct. Okay, yeah. Repeating. Let's understand repeating. When you started, what's the philosophy behind it? How do you select stocks? All of those.
Got it. So we actually run about five small cases, which are on the equity front. So there are five different small cases there. And there are three small cases which are all-weather multi-asset small cases. So that is aggressive, balanced, and conservative. So three small cases for different risk profiles. And the equity ones, although they are sort of thematic, there's an umbrella approach which we follow, which is consistent across whatever small case we manage, whatever portfolios we manage, whether it is a packaged model portfolio or whether it is a customized solution. I think there is an investment philosophy which comes on top at a repeating level, which we try to imbibe across anything that we do. right? So this philosophy primarily is that what we try to look at is the narrative behind any company or stock. So simply put up, I think a lot of people are usually very confused about the start point in terms of, or they tag themselves. We are value investors, we are growth investors, we are momentum investors, we are whatever, right? So our approach is that we look at the story behind a company. What is the story? Where is it headed? What is it set to achieve? What problem is the company solving? What price is the stock available at? Stuff like that. Understand the story, understand the narrative, and then invest in those if those narratives are feasible. So
Yeah.
we've developed a framework to sort of make this simpler. We call it the SEVT framework. So you start with a story. If you like the story, you look at the financial performance, which is the earnings, the E of it. At the end of it, however good a story is, it should translate into financial performance. It should translate into strong earnings growth. Without that, there is nothing that an investor will get. And even if the numbers are beautifully in place, the stock should be reasonably valued as an entry point for you to get into.
Yeah.
So then you jump onto valuations, you make a check whether the valuations are fitting it or not. And then finally, you look at the triggers, because some story may look amazing. The projections may look great as well. Valuations are cheap as well. However, if it's going to play out after 2 years, you're going to sit on a dud investment for 2 years.
Yeah.
So there is a very high opportunity cost, especially in a market like India. You might as well put that money somewhere else and make money there.
Correct.
You can always come back and revisit the stock, but
Yeah.
for now, you can be invested somewhere else. Now, whichever theme we follow or whatever small case we make, we try to follow the same framework. I'll give you two examples. One of our small cases is called monopolies, right? So there we invest in companies with a high market share in whichever segment they're operating. So they may be market leaders, not just the top players, but they may be in the top five, or they may be a good contender to take the top position at some point in time.
Mhm.
So we look at those companies.
Okay.
Similarly, there is another small case called value migration. So the value migration small case, typically what it does is it tries to catch stories which are playing out over 3 to 5 years. It may be the shift from brick and mortar to digital. It may be shifting from PSUs to private. It may be shifting from commodities to premium products. So stuff like that. So any story or value shifting from one place to another is what we try to capture over there.
Yeah.
There also the investment framework is pretty similar. So blanket there, but then obviously we operate different themes of small
Mhm.
cases.
Great, great. I think at least I have understood how the framework is, how you set it up, and what are the things, right? But would you like to share some examples of any stock picks which you have done? What are the
Yeah.
good ones, the bad ones? I think we all have those, right? So I think it'll try to kind of explain what you just shared in terms of your framework. Yeah.
Right. So I think I'll give you one example for each, one success and one failure in terms of how this framework has, what this framework has produced. So on the positive one, I think one of them is called Deepak Nitrite. Love talking about this example. It actually happened before I started the small cases.
Okay.
So it's from my career, but not in the small case.
Okay.
If that's still valid, I'll I think it
No,
should
no,
be.
I
I'll
think
go
it's
ahead with
valid, right? Anyways, that's the thought process you will bring into repeating. So it
exactly.
won't change that way.
So Deepak Nitrite is a company that primarily was involved in the manufacturing of sodium nitrite and toluene.
Yeah.
These were the base chemicals they were making, very commoditized products, nothing special about it. And then they had a division called performance chemicals or specialty chemicals.
Mm-hmm.
These were again two products, OBA and DASDA. So these are brightening agents.
Okay.
They make paper, detergent. The chemical is used to give it that white color and that brightness in it.
Okay.
So the story there was that they discovered an opportunity in the Indian market,
Mm-hmm.
which was that phenol as a chemical, there was a total demand of 2 lakh tons of phenol in India. Deepak Nitrite discovered that about 20,000 to 30,000 tons of this phenol is being domestically produced. The
Mm-hmm.
rest of it is coming from imports. So India is primarily an importer of phenol. Now, to make phenol, you require two chemicals, propylene and benzene.
Okay.
Both of these are petrochemicals. You have a thriving petrochemical
Yeah.
industry in India, although we are importers of crude at a broad level, but
Yeah.
you're making enough propylene and benzene within India.
Mm-hmm.
However, you're exporting that. So, in effect, what India was doing was it was exporting these raw materials and importing the final product.
Mm-hmm.
So Deepak Nitrite saw this opportunity. They said, we are setting up a plant. We are setting up a plant for putting in capacity worth 1500 crores is the
Okay.
capex, right? Now the scale of this was massive.
Mm-hmm.
This is a dent in the story because we were like, the profit after tax is 80 crores.
Mm-hmm.
They're setting up 1500 crores of capacity.
Mm.
The annual revenue of the company was about 1600 crores at that time.
Okay.
So it is a big bite, right?
Mm-hmm.
Very large. So the story was like, story sounds good. It'll translate into numbers, but then the crux of it is, will the management be able to deliver or not deliver?
Yeah.
So you don't want to invest at that point in time. You want to say that, hey, let me see for some execution to happen,
Mm-hmm.
and then I'll figure out because the earnings are fitting.
Yeah.
If this happens, my valuation is also cheap because 2 years down the line, it'll double the revenue easy.
Yeah.
It'll double the revenue, it'll double the PAT at least. So numbers are fitting in, valuation is cheap. Trigger is missing because there is probably a failure here.
Mm.
So I will wait for some time.
Mm-hmm.
What happened is we waited till the plant got commissioned. They set up the plant, and within like I think a year or 18 months or something, that moved very fast in terms of the setup and everything. And within a quarter or two, they had some 40% capacity utilization as well.
Okay.
That's when we said that, hey, there is enough evidence now, and we need to enter right now.
Yeah.
And that's when we bought the story.
Mm-hmm.
So we bought at that point in time, and after that, I mean, everybody can look at the chart in terms of how it's worked out.
Yeah.
The 8x return for us at that point in time,
Mm.
which was driven by both profits also multiplying and valuation re-rating also happening
Yeah.
to a very large extent.
Mm.
So and there was a sort of a lucky strike there as well. So I don't want to take full credit when it comes to Deepak Nitrite. We also got lucky because the DASDA that I was talking about,
Mm-hmm.
2017, there was a point when in China there were major clampdowns on factories because of environmental clearance
Mm.
issues. 80,000 factories in China got shut at that point in time.
Okay.
So DASDA supply globally became deficient.
Mm.
Now, the only legitimate producer at scale at that point was Deepak Nitrite. Prices went 4-5x for DASDA.
Okay.
So, DASDA, which was a loss-making division for Deepak Nitrite in FY17, contributed to 50% of their profit after tax in FY20.
Okay.
And that was something that was not part of our story,
Yeah. Yeah.
but it still helped us.
Yeah.
But great. I mean, if luck is on our side, why not still make
Exactly.
money? Right?
Correct.
You can just be a little modest and say that luck helped me as well.
Yeah, no, I think that's a great example of how you are setting up in terms of framework also. But yeah, I think we also look at what's one failure. Yeah, right.
So failure was, I think, this stock called Praj Industries.
Mm.
Praj is a company that primarily makes distillation equipment. Now, distillation as a process is required in multiple things, right? Anything to do with using biology to process. There is some fermentation there, and that requires equipment at an industrial scale. You're not talking about making dosa batter or something. It's about much larger stuff like
Yeah.
making ethanol, making beer or brewing beer at a large scale,
Mhm.
and that is the equipment that Praj Industries provides.
Yeah.
The story there was that these guys primarily were in the ethanol making space, and India was going very big on ethanol in terms of blending.
Hmm.
So Nitin Gadkari, you would see him come very often on TV talking about
Yeah.
very aggressive targets. 20% by
20.
this year, all the ethanol, petrol will be blended with ethanol. And car manufacturers were also going very heavy in terms of changing the equipment in order to make their cars be able to take that kind of ethanol blending.
Yeah.
Then there was news of the first flight by, I think, Indigo or somebody who used ethanol blended fuel for a flight,
Okay.
jet fuel blended with ethanol. So the narrative was great. And the largest player producing this equipment to make ethanol was Praj Industries.
Mm.
Um, So we said, hey, this looks great. If that is the target, all the sugar manufacturers are diluting, sorry, not deviating their capabilities towards making ethanol,
Okay.
because that's an added revenue stream for them.
Yeah. Yeah.
Instead of making sugar, they just make ethanol from the sugarcane,
Mm.
right? From the residue, they can make more ethanol.
Mm.
So even the derivatives are useful in terms of making further ethanol and creating efficiency. Additionally, what was happening was that most of the oil producer, OMCs, these guys were also setting up captive ethanol plants. So they
Okay.
were also buying sugarcane and feed from others and
Mm-hmm.
setting up their own plants, because why buy it from a sugar manufacturer? You make
Mm.
your own ethanol, blend it, ship it off.
Yeah.
That was the whole philosophy. So we said in any case, ethanol plants are going to increase in terms of capacity.
Yeah.
So we bought Praj Industries. Um, Reflected well again. The earnings part was great, valuations were fitting, triggers were there, everything was beautifully set. What happened, however, is, and I think we at some level failed to determine the risk of this in an appropriate manner. Is that when it comes to the raw material for any ethanol manufacturing, it is going to be food.
Okay.
It's going to be either sugar, rice, maize, popularly.
Mm-hmm.
And any emerging country like India, the government is always going to focus on the hunger of people
Mm.
versus fuel, or versus reducing pollution.
Mm.
So when it comes to cost of running a car or bringing the environment to a cleaner place versus food security, the government is always going to say food security first.
Well.
So so what happened is sugar prices went off the roof, trade
Mm.
wars and Russia, Ukraine, and so a lot of the food prices were going over the top.
Mm-hmm.
So the government said, hey, stop diverting production to ethanol. You need to focus on
Well.
making sugar.
Yeah.
That's when demand dried out entirely.
Hmm.
So
Okay.
sugar manufacturers had to focus on their main business, which is sugar. Ethanol plants, suddenly people stopped putting. Ethanol blending targets were forgotten about for a period of time.
Okay.
And large industries obviously took a hit along with that.
Hmm.
Uh, and that's when we said that, hey, this needs to be reassessed,
Okay.
because the story here changes.
Hmm.
So what the framework does is, sure, we went wrong. We didn't assess risk properly. However, what it also taught us is that the framework helps you keep a check on what the story or the narrative is.
Okay.
If the story is changing or if the narrative has changed midway, you can again assess your earnings, valuations, and triggers and figure whether you want to stick around with the investment or not.
Hmm.
We said
Got,
it's not worth it. Let's get out of it.
got it.
Because government intervention in this space can happen at any time, and
Hmm.
you can't, your money can't be the slave of some random decision which is not in your control.
Yeah. Yeah.
So we got out of that investment hence.
Okay. At least the framework is very clear of how you select stocks. Whether it goes this way or that way, I think there are a lot of other parameters also, right? Like how you shared here. But I think it's a good segue for us to understand when something like this happens, right? So there is a churn in your portfolio. I mean, there are churns which happen, right? So how often does this happen, and what's the impact on the returns for an investor, right? It could be from a small case point of view, right? So if you would like to share those details, like.
Yeah, so see, at any theme that we pick up, typically, other than the framework being constant, we're pretty clear on how we operate or how our vision is set. So we're pretty focused on saying that we are fundamental investors.
Mm-hmm.
We look at stocks from a fundamental perspective. We may choose entry and exit levels from a technical standpoint a little bit, but there is full reliance on fundamentals over anything. That's how we operate. Similarly, we are clear about the time horizon.
Mm-hmm.
So usually we are investing for a 3 to 5 year period.
Okay.
Um, that's what we're looking at when we pick up any stock. So if you look at our churn on a say 20 stock portfolio, our churn would be about 25 to 30% on an annual basis.
Okay.
So if you look at a holding period of 3 years, typically you're refreshing 100% of the portfolio in a span of 3 years.
Okay.
That is if our thesis goes according to our plan
Mm-hmm.
and if the stock price meets what we are envisaging it to be
Okay.
earlier. However, there are some changes to it at all points in time, right? Like, for example, sometimes the story plays out very fast.
Hmm.
You're expecting double returns in 3 years, but it plays out within 3 months. And that
Okay.
has happened a lot in the last 3 years,
Yeah.
where prices have overtaken fundamentals.
Yes.
Uh, so that's when what you think will happen in 3 years or 5 years happens within months or weeks.
Hmm.
Then we get out
Okay.
because we've made our money. We think the valuations have peaked out. There is no more juice left here. That doesn't make sense to stick around. We don't believe in frictionless movement of stocks.
Yeah. Yeah.
So if the target has been achieved and we don't see any further upside, cut, right? Similarly, there are times when we go wrong. So Praj, for example, we exited within a few months. It didn't wait for 3 years for it
Hmm.
to play out. Similarly, some stocks, if they hit like a 20%, we keep reassessing them on every 10% of a dip. And we keep recalibrating ourselves in order to check whether the story is still playing out or not. So we may exit faster. But overall, you can expect a 25 to 30% churn on a annual basis. We're
Okay.
not really fond of shifting our portfolios very often. The other time when we'll sort of churn the portfolio, other than taking a very stock specific call, is also when we're taking a bit of a market call.
Hmm.
So for example, over the last year is a good example. Exactly 1 year back, our portfolio was very heavily value migration. I'll take as an example. It was very heavily focused on mid and small caps.
Okay.
About 70% of the portfolio was mid and small caps. Today, that number is about 40 or 50%, 40%
Hmm.
maybe. It has become more large cap heavy. Earlier, the amount of growth stocks, growth oriented stories we had was much more. Now, the value oriented stories are much more.
Hmm.
Um, Similarly, defensives had a smaller portion in the portfolio at that point in time. Now, defensives are larger. So, when there is a market shift that we see,
Hmm.
for a prolonged duration, we sort of take a preemptive call and position ourselves to ride the wave accordingly.
Got it.
Now, what we're doing is we're again churning, we're not really churning, we are going to churn the portfolio, or we're in the process of doing it, where we're again doing some bit of value picking at these levels when the markets have fallen so much.
Hmm.
So, a lot of growth stories which were available earlier, which we couldn't touch, which were on our radar, but we couldn't touch really in terms of or find an entry point. Those entry points are now being visible.
Okay.
So now there'll be some churn in the portfolio, which is not stock specific,
Hmm.
but which is a more market
Market.
oriented trend, where we are sort of again placing ourselves before the wave comes and hits us.
Got it. Got it. Got it.
For mutual funds, there is no tax on transaction, which is a big advantage for mutual funds, right?
Yeah.
For small case, unfortunately, every single transaction will attract a capital gains tax.
Yeah.
Um, and hence we try to keep our churn minimal.
Hmm.
So we understand that at the end of it, if you're charging a fee, which is going to turn out to be 2%, or even if you're investing a small amount, larger percent of your portfolio,
Hmm.
um, then it doesn't make sense to be that active in terms of churning, because
Yeah.
churning comes at a cost. And
Correct.
that cost is directly borne by the investor, because that is execution is in their hands.
Correct.
So they're paying you an advisory fee, but execution is in their hands. So the way we look at it is that the return for the investor has to be justified, or has to be materially higher over a 3 to 5 year period, including all the costs. Whether it is cost of not just the money they pay to repeating, but also the transaction cost that they carry out by themselves.
Got it.
So when we do this approach and we keep our portfolio churn to that level, I think we are doing much better compared to the median
Hmm.
when it comes to our churn rates are lower, and hence our net returns are higher.
But I don't think you have like schedule, right? Every month you will have some kind of churn or every quarter. I think it's purely based on how the market is and all the things which you mentioned.
Yeah. So it's not timed really. So we don't
Okay.
operate in a fashion where every month we'll take stock of, okay, what do we do now? Or every quarter that is happening on a daily basis. Like there
Hmm.
is real time addition, increments to our knowledge, to our judgment,
Yeah.
which is happening. We don't put a date to it saying कि आज research करेंगे. That's that's our daily job.
Yeah.
So we
Yeah.
don't put a date to saying when we'll rebalance. It is need based. If there
Got
is a need, we will do it. If there is no need, we will not do it.
correct.
And I think that is a very that brings me to a very interesting point as well. The low churn comes as a sort of there's a clash on it from investors at some point. You're not doing anything.
Exactly.
So as
Yes.
an advisor, we get this a lot. We get this, it's like a fight people have with us. Why are you not acting? Why are you not doing anything? Why are you taking money? But I think my simple point there is that inaction is also a choice.
Yeah.
It is a
So,
very well informed, conscious decision to not act.
correct.
And that also requires knowledge and judgment. So if I'm getting paid to not act, it is still justified because it is my judgment and experience which is top.
From an investor point of view, I think let's look at when someone is looking to invest in small case, what they should be looking at. What are some of the common mistakes which you have seen from an investor point of view, which they have done so far, which you would like to share? I think it'll be good for someone who is looking to invest, understand what they should be doing and they shouldn't be doing.
Yeah, so number one, I think there's an elephant in the room here when it comes to how investors wrongly pick the small case. Um, what we've seen is from our data, and I think I can extrapolate that to the entire small case universe,
Mm-hmm.
is that the highest selling product is the one that has the highest returns over the last 12 months.
Sure.
That's always the highest selling product.
Okay.
For the first year, it was the Monopoly small case, which was actually featuring in the top 10 across small case
Okay.
in terms of returns. So
Mm-hmm.
the best selling product was Monopolies. Everybody would buy Monopolies. Every customer query would be Monopolies. After that, the next 2 years, value migration small case delivered like a phenomenal doubler every year sort of return, right? Or doubling every year.
Mm.
Again, top 10 in amongst the entire small case universe as well. Number one selling product was value migration. Nobody's buying anything else. They're just buying value migration. Now, what has happened is value migration ka base has become too large
Mm.
over last year because you deliver 176% or some return like that. What can you deliver on? Of course, we strive to continue doing that, but the market
Mm.
is not supporting it.
Correct.
And the higher your base for every day for that last year is, the more difficult on a daily basis. So YOY returns will keep looking worse.
Yeah. Mm.
So optically and mathematically, it is not possible,
Mm.
right? So now the number of complaints are the highest because value migration people are like, hey, what happened here? We're like, look at the market also, right? You can't just sort of do that. So number one, I think mistake is looking at past returns,
Mm.
that to the 12-month returns. Um, so the way we tell people to correct that usually is that number one, look at not just 1 year, but also 3 years. Look at 5 years. Look at if the company hasn't existed for 5 years, there are other things to look at. But look at 6 months, 1 year, 5 years, 3 years.
Mm.
Look at the bad periods. Look at the drawdown.
Mm.
Because how much risk you're taking for the returns you've generated in the past will also determine how the portfolio will do when the markets turn tide. And
Correct.
the last 3 months are a beautiful example of that,
True.
of the amount of drawdown that the small cases have seen.
Yeah.
So if you just open any small case page, you
Mm.
open their chart, you're able to see the bad period for the market because you can see the benchmark there as well. You can compare how the small case performed during that period.
Yeah.
In all likelihood, the drawdown will be larger compared to the benchmark.
Mm.
And obviously, the portfolio is less diversified, it is more concentrated. It is very likely to be in the mid and small cap space. That's how most small cases today are built. And that will have a larger drawdown. However, how much larger? So, is the manager able to mitigate that risk, foresee it, and hence cushion the portfolio? That is important. You may not care for it from a whenever the markets are great, but that one period when the market turns bad, all your attention needs to be at, let's say, protecting wealth rather than wealth creation.
Yeah.
So I think that's an important thing to look at.
Mm.
The other important thing to look at is the churn.
Mm.
Small case gives you that information as well. How much is the portfolio being churned?
Yeah.
That is an important metric because it's not only about the cost of churning,
Mm.
it's also about the ability for you to execute the churn. If a churn is happening every second day, every third day, every week, you can't even go on a holiday without rebalancing.
Yeah.
You don't want to be in a situation where this becomes your, this captures a significant amount of your time.
Correct.
Investments are supposed to be pretty hands off, not hands on. Hands on for
Mm.
people who are working in the field, not as an investor.
Yeah.
So you can't bear the load of execution on a regular basis using that. Unless you're there, right? You're there, this is your,
Mm.
you have all the time to do this. The next thing is, which also Smallcase does a beautiful job at providing, is providing you the return adjusted for tax and costs.
Mm.
So when you're comparing small cases, you have a filter to say 12 months basis, which is the highest to lowest performing. But when you figured or shortlisted five small cases, I'd urge people to go and look at the net return and
Mm.
compare it across the five small cases. That's when the impact of churn, taxes,
Correct.
etc. Because if somebody is booking profits at 10%
Mm-hmm.
gains repeatedly versus someone who's picked up one stock and booked it after 100%, the amount of net return difference is going to be massive between those
Huge.
two.
Sure. Yeah.
So that is the other thing that people need to look at.
Mm.
And lastly, I think expenses or the management fee, purely the cost of the small case. Uh,
Mm-hmm.
there was a time when, I mean, I remember a time when somebody invested some 10,000 bucks in the all-weather small case
Mm-hmm.
and paid a 4,000 rupee fee on it. And I
Mm.
actually called them and I was like, just take the money back. It's not making sense for you.
Yeah.
It's not making sense. I'll feel bad taking that money because I'm taking away more money than that small case will ever generate in a 1 year period.
Correct.
40% for a multi-asset portfolio is not doable.
Doesn't make
Let's be
sense.
practical. However
Yeah.
good the markets are.
Correct.
So
Correct.
we refunded the money. And people, I don't think people understand percentage of AUM,
Mm.
but somehow the perception is 4,000 में मिल रहा है,
Yeah.
5,000 में मिल रहा है, डाल देते हैं. No, 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 no. You need to look at it as a percentage of the
Percentage.
amount of money you're investing.
Correct.
If it is greater than 2%, it's not making sense.
Yeah. Yeah.
You'd
No.
rather invest in a mutual fund.
Correct, correct. I think that's the best comparison if someone is starting off. Where do we compare? I think, like you mentioned, 2% is a good number for us to even look at how is it going. So if someone is investing, let's say 1 lakh, then the fees has to be lower than 2,000, right? So I think which is what people have to look at your investment amount, what you're doing, or look at the other option of investing from an AUM, I think percentage, right? You have also have that
Yeah.
option to do that. Okay. Who should be investing? Is it for a long-term investor or is it for traders? Like who should be looking at investing in small case? What's your thought process on it?
I think like there are different types of investors. Investors love to tag themselves, right? Value investor, growth investor, momentum investor, whatever. Investors love doing that. I mean, fund managers love doing that. I think investors have a style as well. They're just not tagging themselves. So I think investors need to understand what their type is.
Okay.
Um, some are very patient and long-term investors. They won't bother fund managers on a daily basis. They
Mm-hmm.
won't bother their advisors on a daily basis. Some are excited by the churn. Some want activity. Some like activity. They do not believe in. We've got many investors who we've doubled a stock, but
Mm-hmm.
they've taken their own decisions and entered, exited, and done all that.
Mm.
And while we've made 100% return on the stock, they've made some 25-30%.
Mm.
Then after 3 years, they come back to us and say, "Hey, you were right." I'm like, I always knew I was right. You didn't know I was right. So I
Right.
think an investor needs to understand their type
Mm. Got
and
it.
invest in products that are suited to their type. Because
Mm-hmm.
if they're invested in products that are not suited to their type, they're going to be constantly dissatisfied with what they're getting.
Okay.
And that dissatisfaction inherently, as an Indian consumer, you learn to blame the service provider.
Correct.
But if my approach is very clear and I'm telling you that I'm a long-term investor, I don't want a guy who's waiting for a rebalance every second day.
Mm.
He's going to bother me, I'm going to get bothered. It's going to affect the relationship very negatively from both sides.
Correct.
So
Correct.
when we figure sometimes, and a lot of times this happens when we figure that investors, and I'm not saying that's wrong,
Mm-hmm.
everybody has a type. They're right in their own place. But this association is not working out then.
Mm.
So sometimes we do that actively when people call us, say, 5 times a month, asking about a rebalance update or asking us individual views. We're open to sharing our views, insights, having a
Mm.
conversation. But if you're not liking where you are, we usually urge people to get out then and
Mm.
find something that is more suitable to them.
So
So I don't think there is a type. I think there
yeah.
is a type mismatch usually.
But what's the general average investor? I mean, in terms of investing, what in a small case? Like, do you have an average amount?
So what we figured is that we have most of our small cases are sorry. Most of our small cases are have a minimum investment amount of anywhere between 50,000 and 75,000.
Hmm.
However, the average invested amount would be about 3.5 lakh. Now,
Hmm.
I don't know if that is virtue of who we are targeting from a brand perspective,
Mm-hmm.
because we've got a slightly fresh brand, slightly
Hmm.
casual. Is it virtue of that, or is it virtue of our fees?
Hmm.
Because if my product is priced at say 6,000 bucks, then 3 lakh makes sense.
Yeah, correct.
So I'm not sure what it's a virtue of because I have data only on my small case, not on the
Hmm.
others. But at least from our perspective, what we see is that average is pretty much that 3.5 lakhish.
Great. So now let's look at from your point of view, right? What are the themes we are looking at? Current market conditions as of Feb 2025. Let me highlight it because not sure when someone will look at this video, right? As of now, I think it's everybody's talking about dark days. The
Yeah.
doom is here, all of that, right? So let's look positive and see what are the themes you repeating is looking at in the current market and what you should be looking at investing.
So I think one is that we think it's time to change gears. I think pessimism is overdone at this point now. We've reached that stage where we feel we're turning the corner.
Hmm.
The economy, according to us, seems to be at the bottom of where it could be. So you can see a turn from here. That's resonating well with RBI's comments as well, including whatever the budget comments,
Budget, yeah.
etc. Last quarter was pretty much it in terms of negatives or
Hmm.
growth having bottomed out. Um, a lot of disappointment came in from the budget angle,
Hmm.
uh, because it's not growth oriented apparently. I keep telling people that we are accustomed to a very wrong set of budget expectations. Our expectations have very are heightened over the last 5 to 7 years because of what budgets have been like,
Hmm. Hmm.
especially after COVID, because that was the need of the hour.
Hmm.
It was a special time. You had to boost growth. Monetary policy was not supportive. Capex had to be done. Hence, you were seeing a doubling of capex over 3 year periods, unseen before.
Hmm.
Um, so that is not a typical period. So don't get used to it. Now that is not the requirement. And hence, what we feel is that the budget is pretty balanced. There is enough being done. Capex, it's not like it's not growing. It is still, you're giving a 10% growth on the capex number. You're doing enough on the consumer front. And most importantly, you've got fiscal policy, which is balanced along with a progressive monetary policy as well.
Hmm.
Last 3 years, rates have increased by 250 basis points. This year now, if you see a 25 or 50 bips cut, that is still materially different from what was over the last 3 years.
Yeah.
So from that perspective, we think there is enough going on from a fiscal plus monetary standpoint
Hmm.
in order to boost the economy, especially from the low base that the economy is now created.
Yeah.
So from that angle, we are pretty positive on how things are. We think from a long-term perspective, we are pretty unwavered because we think 3 to 5 years perspective, great story. You can chipka all those consumption, under penetration, blah blah. India is in a sweet spot. All those things remain. Nothing is changing that,
Hmm.
right? So from that perspective, we are comfortable when it comes to the long term. But how we are playing the market will change now.
Hmm.
uh, the free rally that you'd seen over the last few years, uh, rather than free, I would call it a very uniform rally. Whatever you picked up, the divergence between two picks would not be material in
Hmm.
the same sector or in the same space. It would all move in tandem. So your blind bets would also make you decent money.
Hmm.
I think that will change now. So now it will be more driven by fundamentals. It will be more driven by stock specific action.
Hmm.
So when people currently in this week, especially when they're saying mid and small caps will do XYZ, I think that's the wrong way of looking at it now. I
Hmm.
think you have to be very selective. You have to be stock specific. What are you playing? Which stock are you selecting? What is that stock in terms of earnings visibility? Is it cheap or not? that will drive returns. So our general view for this year, at least 12 months from now, is that it's going to be a stock pickers market. It is not a everybody wins market. It's a very largely stock pickers market. So the themes we're playing, number one, we're playing IT as a defensive, as a good proxy to robustness in the US economy, which is doing very well.
Yeah.
That's one thing. Second, we're doing healthcare.
Mm.
Healthcare from the angle that the sector is doing amazingly well, a lot of new opportunities, especially in the CDMO space. So pharmaceutical and chemicals together.
Mm.
So a lot of new opportunities emerging there. Um, the third thing we're doing is we're picking up manufacturing as a theme as well.
Okay.
So auto ancillaries, equipment, industrial equipment that is manufactured and exported, electronic manufacturing.
Mm.
So various pockets in the entire manufacturing scheme of things. We're going heavy on that. And then we're playing some of the other themes, which are again common, right? Where you want to play something like electric vehicles, but through incumbents.
Mm. Mm.
You want to step in, step out of internet. Internet, we're kind of staying away at this point. We think there's too much of a bloodbath there.
Mm.
And we're playing consumer.
Okay.
So consumer again, not only because the government shifted its focus from infra to consumer,
Mm.
but also from the entire perspective of interest rates stabilizing, inflation being under control, and from various stuff like pay commission coming
Macro
in,
level.
tax thing. Yeah, so several factors there. So and consumption having not performed well for the last 4 years now.
Yeah. Yeah.
Um, and I think one major factor that is also underspoken about is that last 4 years, 4 or 5 years, we spent in a El Nino situation,
Mm.
which is very typical for India in terms of erratic rainfall, high temperatures, heat waves,
Mm.
which also sparks a lot of the inflationary stuff.
Yeah.
Versus now, I think you'll enter a La Nina phase,
Mm.
um, which is more supportive for the Indian climate, better consistent rainfall, lower peak temperatures, stuff like that.
Got
May not play out in this year itself. Looking at the climate, it's not looking like it. But sure, I
Yeah.
mean, the consumption is one more theme we're playing.
Got it.
But again, backing market leaders in any of these themes, that's an important one.
Mm.
So players with a proven capability, proven credibility, good corporate governance structures, and players with, again, story and hence visibility and at a reasonable valuation. So our framework sort of
Yeah.
comes in
Perfectly
here.
fits that. Correct. Okay, great. I think we've covered most of it. But let me give the stage to you in terms of how do you, if someone is looking at investing in small case, right? Why should they invest in repeating? I think you explained the investment thesis, philosophy, and all of that, right? Uh,
Yeah.
Something different which you want to share, right? On why someone should look at repeating and why they should be looking at.
So, no, I think just a couple of reasons. One is that we are here for keeps, right? We are not here for short-term stuff. If you look at the small cases we've launched, they may be directionally thematic, like monopolies and value migration and stuff like that. But we've not launched sector-specific small
Hmm.
cases. We've not launched a manufacturing small case. We've not done any of that stuff. I
Hmm.
think that is short-lived stuff.
Hmm.
So anybody who's looking at meaningful wealth creation over 3 to 5 year periods, I think we're the name. So
Okay.
we are pretty clear in terms of what we want to achieve, what we are good at, what we've proven over the last 3 years in terms of returns. Every small case has materially beaten the benchmark on a 3 year period.
Hmm.
1 month, fine. 3 months, fine, whatever. But I always urge people to look at 3 to 5 years
Yeah.
forward. So I think my only selling point is that if you're looking at meaningful wealth creation, if you're a patient investor, if you are focused on low churn, picking up good quality stocks, playing stories over a few months and years, then we are very aligned in terms of what we are pitching, what we are thinking, what we are doing, what we are implementing, and what we are delivering.
Got
So that alignment is what people should invest in us for.
Yeah, I think that's all I had in terms of what I wanted to, yeah, pick your brains on, right? On what you're doing, how you're doing, and all of that. So I think great conversation, Sagar. Thank you so much for spending so much of time. Yeah, and yeah, I'm looking forward to hear from you in next 6 months or one year. We'll catch up. let's see how the market is doing, repeating is doing. I think it'll be great for our audience also to understand. So thank you so much.
Thank you.
Thank you.
Thanks for the opportunity. Great talking. Hope for many more such fruitful conversations.
Thank you so much. Yeah.